Hey guys, it's Aaron Fedewa with the Bluefield Group, and today we are with none other than the CEO of the Bluefield Group, Michael Smith, and we are here to talk about real estate investing. We've all seen those great real estate investing shows on HGTV and whatnot, and I got a lot of clients coming to me asking me how do I get into it, or they got a lot of questions about it. Why real estate investing? Why would somebody want to get into it?
You know, that's a great question. The two things that I hear most often are either A, I want to generate some passive income, or B, I just really don't like my job. I don't like what I'm doing right now, and I want to do something more exciting.
Yeah.
And they see all these shows that depict real estate investing, and it just seems really exciting to them. The reality is that it's not anywhere near as glamorous as they make it out on TV. And real estate oftentimes is nowhere near as passive as people think it's going to be. Mm-hmm. Real estate investing is not like stocks and bonds. You don't just click a mouse and buy some shares and then see if it goes up or down. There's a lot more work that goes into it. You've got to identify a property, you've got to close on it. Sometimes there's renovations involved. You've got to put a tenant in place and then manage that tenant and collect rent and maybe evict someone. I mean, there's a lot that can go into it.
There really is.
But that being said, real estate can be a phenomenal investment. And if it's done right, it can generate rates of return much higher than what you can see really anywhere else. For example, the S&P 500, which is a stock market index, over the past 50 years, I think has averaged somewhere between 8 and 12%. And in real estate, you can get much higher than that if done correctly, and we can get into more details about that later. Now, I personally choose to invest in real estate because it's something I know and understand. Because I do residential real estate for a living, I really understand the market. Mm-hmm. So real estate investing might not be the right fit for someone if they don't understand real estate.
Right.
Okay?
Yeah.
Some people might be great at investing in stocks if that's what they really understand. Maybe you should invest in a small business if that's something you understand. So I think the key is invest your money in a place that you understand. Don't ever buy a rental property just because your realtor said you should. It needs to be an investment that you understand. Mm-hmm. But real estate is great because you can have a lot more control than other types of assets.
There's numerous different types of real estate investing, but what are some of the most common?
Yeah, there's so many different ways to invest in real estate. Yeah. There's a bunch of different niches out there, but probably the three that we see most often are wholesaling, flipping, and rental property. Okay. So just a really high 30,000 foot view of each of those categories. To give you some context, wholesaling is where you're essentially a middleman between a buyer and a seller. So a wholesaler will go speak with a motivated seller, someone who owns property, wants to unload it for whatever reason. Maybe they're about to go into foreclosure because they can't make their payments. Maybe they inherited the property and they don't even live in the same state and they just don't want to deal with it. They'd rather just liquidate it, right? Maybe the property needs a lot of repairs and they don't have the time or the money to fix it up. And they don't want to put it on the market and go through the hassle of showings and all of that. For whatever reason, someone is motivated, needs to get cash for their home, okay? Mm-hmm. If I'm a wholesaler, I'm going to meet with you and negotiate a contract to purchase your home. Okay. But I'm not actually going to be the one closing on that transaction. Like I said, I'm a middleman. I'm going to assign that contract to the end buyer. So let's say, for example, you're the seller and I negotiate an offer to purchase your home for $50,000. Okay. But I've got another investor who's either going to flip this property or keep it as a rental, and I know they'd be willing to pay $70,000 for your house. Okay. So there's a margin there of $20,000. Yep. You get your 50 and you're happy. This guy pays 70 and I make the difference, the 20. A couple different ways to do that. That we could get into, either through a double close or an assignment of contract. That's minutia. The 30,000 foot view is I'm a middleman. I connect a buyer and a seller. Okay. So that's wholesaling.
And what about flipping?
Yeah, flipping is very popular right now. A lot of people getting into the market, because they watch these shows on TV, right? And I can tell you that flipping houses is not as glamorous as they make it look on TV. So flipping is where it's simple, right? It's there's a house, I buy the house, I make improvements to it, and then I resell it at a higher price, right?
Yep.
And hopefully you make a profit. So let's say, the guy who bought your house for $70,000, right? Puts $30,000 worth of renovations into it and sells it for $150.
Okay.
Right? That's an example. Now you've got costs in it you've got to take into account. Closing costs, taxes, insurance, real estate commissions, all those different things, right? But essentially, you pay X, you put Y into it, and you sell it for Z, and, you make a profit. Flipping seems to be really popular, especially just from the aesthetics of it, right? People like to pick out colors, floor and cabinets, countertops, all that stuff. It's just a fun thing to do, right? Yeah. But again, not passive income. If you're getting into real estate investing and hoping for passive income, flipping is not for you.
Some passive income.
Right.
What would be? I'm assuming that's rentals. What's that about?
Yeah, rentals can be a great way to generate passive income. You've got to be careful, right? So there's a lot of great things about real estate. One of them is leverage, right? The ability to put, let's say, 20% down on a property. So you're not having to come up with all the cash out of pocket to buy an asset that's hopefully going to appreciate in value. If I buy a $100,000 house and I put 20% down, so I'm in it for $20,000, and I borrow $80,000 on a mortgage, let's say that house goes up in value by 3%. Okay, so I buy it for $100, next year it's worth $103. Okay, if I had paid cash for it, I would have made a 3% return on my investment. Right, but because I'm leveraged and I only put $20,000 into it, I've got a 5-to-1 leverage ratio there. I'm actually made a 15% return on my investment because I put in $20,000 and I got $3,000 worth of appreciation.
It's the little things that people don't know.
Right, but you need to be very careful. A lot of people got into a lot of trouble over leveraging, borrowing too much money, just banking on appreciation. Right, so I see that real estate values are going up crazy amounts. Like I think they went up about 10% in Greenville last year. Okay. Now that's not going to happen forever. Where people get into trouble is they put down as little as possible, they borrow all this money, and then eventually the market slows down and maybe the values go down. And if you're buying in certain parts of the country where the rent to price ratio might not be very high, you might not have positive cash flow on that real estate property. So making sure that you analyze the property you're looking at as a rental from a cash flow perspective, and saying, okay, my payment's going to be this much. I'm going to have property management. I'm going to have maintenance, repairs, those types of things, vacancies. And after everything's said and done, I'm still going to have positive cash flow. Oh, and by the way, if it goes up in value, that's a huge bonus, right?
Of course.
In my opinion, that's the way to buy a rental property. Okay. So you're not banking on the appreciation. You're not going to go bankrupt if values go down because you can still cover the payment from the cash flow.
And we already said it. It's already popular, and because it's so popular, what would you tell somebody who's just first starting out? What of those three? What's a good one to get into just starting out?
I think it's the answer is it depends. So what type of investing is right for you is going to depend on your goals, your strengths and weaknesses, your resources. So let's say you're in your 20s and your goal is to build a portfolio of rental properties so that you can retire and have passive income. You've got a much longer investment horizon.
Yeah.
So you can buy a property every few years and eventually have enough to cover you, right?
Right.
If you don't have the time to put into like going around and finding motivated sellers or renovating houses, maybe rentals is a great thing for you. You're going to either need to have money or a partner who has money, right? Most likely going to need to have good enough credit to qualify for a loan, unless you can get private financing or different things like that. But let's say you want to get into the flipping side of real estate. That's more of like a job or a business than an investment. It's much more active than passive, right?
Yeah.
So to get into flipping, you really need to have some time on your hands or some money or a partner. So you've got to bring something to the table. Maybe you're good at finding deals. Maybe you're good at analyzing properties. Maybe you're handy and you can do the work yourself. Maybe you're good at managing contractors. Maybe you're just the money person and you have a partner that finds the deals and does the renovations. So it's just like any other business, right? If you were to ask me, hey, should I open a restaurant or a photography business, right? It's not like a one size fits all, the restaurant is a great business. It's what are your strengths and weaknesses, what are your resources, and what are your goals.
Okay.